Welcome to The Explainer. Today we are unpacking something that is literally reshaping the modern world right in front of us. We're looking at the 2026 Strait of Hormuz crisis. And let's be clear up front. This is, without a doubt, the largest and most sudden energy supply shock global markets have seen in decades. What kicked off as a regional conflict has completely mutated into a global economic earthquake. So we're going to break down exactly how this happened, the massive toll it's taking, and where the global economy actually goes from here.
So let's just jump right in with the multi-trillion-dollar question that economists and world leaders have been desperately scrambling to answer for over 5 months now. What happens when 20% of the world's oil is choked off, practically overnight? I mean, it sounds like the plot of a Hollywood geopolitical thriller, right? But since late February of 2026, this has been our absolute reality. The sheer scale of this crisis has just tested the limits of our entire global infrastructure.
All right, let's get into Section 1, the 34-mile global choke point, and why global shipping is at massive risk.
It's a crazy bit of geographic irony, really. Think about it. The engine of the entire global economy relies on a remarkably narrow gap of water. It's just 34 miles across at its narrowest point, sitting right there between Iran and Oman, connecting the Persian Gulf to the rest of the world. Through this one tiny blue corridor flows roughly a fifth of the entire world's oil, along with about a fifth of the world's liquefied natural gas, or LNG. It is literally the foundation of our global energy supply.
To really put this into perspective, you have to look at the daily traffic. Normally, on any given day, you'd have about 73 massive vessels squeezing through there. But as of August 2026, live shipping trackers are showing something like 2 vessels a day. Just 2. And the craziest part is, this critical artery wasn't even closed by a formal legal blockade. It was reduced to an absolute trickle by sheer fear, extreme physical risk, and totally unworkable insurance economics.
Which leads us to Section 2, How the Strait Closed, a timeline of the crisis.
Things moved incredibly fast. On February 28, 2026, the U.S. and Israel launched a coordinated air campaign against Iran, which included the assassination of Supreme Leader Ali Khamenei. Iran hit back immediately, launching missiles and drones at Israel, U.S. military bases, and Gulf allies. By early March, Iran's Revolutionary Guard Corps heavily mined the waters and basically declared the strait closed to unfriendly nations, threatening to fire on unapproved ships. Then, on April 13th, the U.S. retaliated with a full blockade of Iranian ports, completely cutting off Iran's own crude exports, about 2 million barrels a day. So a geopolitical conflict rapidly mutated into this mutual, completely devastating shipping blockade.
Now, we can't forget that this isn't just about lines on a chart or barrels of oil. The human toll here is very real, and it is devastating. Throughout this crisis, at least 17 merchant ships have been damaged. 7 were outright abandoned by their crews, and 2 were captured. Tragically, 12 seafarers are dead or missing, along with a port worker who was killed in Bahrain. And just as a harsh reminder that the water is still incredibly hostile today, a cargo ship was recently struck by an unidentified projectile right off the coast of Oman. The physical danger to human life out there remains sky high.
Moving on to Section 3, the economic shockwave and the ensuing global market panic.
Naturally, a physical bottleneck like this instantly triggers a financial one. If we track Brent crude, which is the global benchmark for oil, you can literally see the panic set in. February 27, right before the strikes, Brent was sitting at a totally manageable $71 a barrel. Within 2 weeks, it shot to $94. By late March, futures were trading near $113. Goldman Sachs actually went on the record calling this the largest supply shock in the history of the global crude market.
By the end of March, the price of crude oil had surged by 65%. Let that sink in. That is a jump of about $46 a barrel in a matter of weeks. It officially went down as the single largest monthly price jump on record.
And the underlying fundamentals? They just collapsed. Global oil output fell by nearly 7 million barrels a day year-on-year in the second quarter of 2026. We haven't seen a quarterly drop like that since the COVID lockdowns. OPEC production plummeted by over 30%. But the most crucial takeaway here is what economists call demand destruction. People and industries simply could not afford these skyrocketing prices, which forced global oil consumption to just collapse right alongside the supply.
And because this waterway is also a massive bottleneck for LNG and fertilizer, the disruption hit energy, food, and shipping all at once. Meaning, practically everything you buy is getting more expensive. Wood Mackenzie put out some really sobering economic models on this. They're projecting the Middle East could see a massive 10% contraction in GDP for 2026. The EU is looking at a 1.5% drop, the US is slipping below 1% growth, and China is slowing down to around 3%. The longer those ships stay docked, the more this bleeds directly into global industrial activity and your everyday cost of living.
So let's look at Section 4, the new gatekeeper, Iran's maritime toll.
Here we are, in August 2026. Oman is trying to broker a deal, and there is real diplomatic movement happening. But this quote from a member of Iran's negotiating team really tells you everything you need to know about who holds the cards right now. When talking about a new temporary safe shipping route, they stated flat out, Iran is dominant. Tehran's endgame here is to firmly control the security, the demining, and the maritime services along this new route.
The interim deal they're hashing out basically has 3 phases. Phase 1 is setting the exact coordinates for the new routes with Oman, which Tehran claims is already done. Phase 2 is a temporary 60-day toll-free window just to get the ships moving again. But Phase 3, that's the kicker. Once that 60 days is up, around mid-August, Iran intends to start charging permanent maritime fees. So that old idea of going back to normal, it's gone. Iran is effectively negotiating itself into becoming a permanent, paid gatekeeper for one of the most vital waterways on the planet.
Which brings us to Section 5. What happens next? Looking at future scenarios.
Analysts are all over the board right now, so let's look at the 2 extremes. In a quick peace scenario, the agreement actually holds, the strait fully reopens, and Brent crude eases back down to around $80 a barrel by year-end, eventually settling near $65 in 2027. But contrast that with Wood Mackenzie's absolute worst-case scenario. If the closure drags on with recurring flare-ups, Brent crude could approach an unthinkable $200 a barrel. Refined products, stuff like diesel and jet fuel, could hit $300, which would practically ground aviation and trucking overnight. That scenario forces global demand to plummet by another 6 million barrels a day, simply because the global economy would break under those prices.
And if that worst-case scenario plays out, we're looking at a huge structural shift. One oil trader summed it up perfectly. They said a prolonged closure means the world will be, quote, forced into an accelerated energy transition, not by policy choice, but painfully and very quickly as regions fight each other for scarce supply. So we aren't just talking about a temporary dip in supply anymore. We're talking about a permanent alteration to how the world consumes energy, born entirely out of desperation.
And here's a massive takeaway from Goldman Sachs. Even if everything goes perfectly, even if the Oman deal works and the ships start moving again, the global market has permanently repriced the risk of this choke point. That risk premium is now completely baked into long-term oil contracts. The world has just been reminded, in the absolute most painful and expensive way imaginable, just how concentrated and vulnerable our energy supply really is.
Which leaves us with this final thought. When we look at the wreckage of this 2026 energy shock, the real question isn't just about when the strait will reopen. The question we have to ask ourselves going forward is this: can the modern global economy actually survive relying on a single fragile 34-mile channel? It is a serious reality check, and it's one that is going to shape global energy policy for decades to come. Thanks for joining me for this explainer, and definitely keep your eyes on those shipping lanes.